what will happen to I don't like you sectors, real estate, power, maybe some metal companies?
So metals, I think, will have some pain going ahead because of what's going to happen in the world. So it may not really be the best of time to go there. And I'm especially worried about China. I don't know it so well, but just seeing it from a distant, it cannot be that a country continues to put $4 to create $1 of assets, which typically don't have returns because the most of their money goes now into infrastructure and real estate. Something has to give way over there. If and when that occurs, it casts us, pall of gloom over the whole commodities complex, which makes, a climatic bottom. And it's consistent with market cycles, where the leader of the previous cycle goes to a period of complete abhorrence. And you just don't want that asset. And it's no surprise in the last year that the leader of the last bull market, which was BRICS, Brazil, China, India have been the worst performing markets.
Are we there yet?
I'm not the sort of God who picks market bottoms and tops. All I'm saying is I read the tea leaves the way one has seen it. And it's consistent with sort of that sort of flow. You also mentioned power and you also mentioned real estate. Now real estate, as I said, there's 140 billion of actual buying going on. So real estate companies which have not been too smart in over leveraging or over committing or buying land for the next 20 years are actually in good shape. It's people who've over committed themselves or overhyped what they've done. That's where the issue is. From a market's perspective, again, the problem, lay at our end. We got excited like when every new sector opens, we don't know how to value it. So we went to the extreme of valuing on NAV based on projects which may or may not have, finally come, to a nadir where we are saying we don't trust the book value even of these companies. The truth lies somewhere in between, and I suspect in a 5-year cycle, some of these companies will start getting valued on earnings, which is really what matters to companies in the stock market, and you'll find a mean somewhere. And just as every single tech stock didn't perform in the 1990s, it's not that every single real estate company is a bad company in the 2010 to 2020 period. So there will be winners over there as well. Coming to power, again, it suffered from the hype of 2007 and 8. We went through the nadir post this coal crisis, which we are seeing even now. But that gives you the hope that actually in a power-starved economy, in a resource-starved economy, unless power comes, we are 1/9 the consumption of China in power with the same level of population. If we think our power capacity has to be 8x, 9x of what it is today, unless the economic returns to that sector come back, there will not be capacity creation happening. And as we speak, projects are getting slowed or stalled because there's no fuel or the SEBs are not in a position to pay, or you're not able to get the land or environmental clearances. These shortages are what lead eventually to inflation. But what comes between a shortage and inflation is profit. What comes ahead of profit is stock market return. So it could be a very interesting cycle lying ahead for these players.
So don't ride them yet.
Oh no. The ones you hate are the ones which give you the most return.
You made a point that there is a serious case for PE expansion for Indian markets in the next 3 to 5 years. So which other sectors to your mind could help this PE expansion?
Well, one is the whole market multiple. As I said, it's a reciprocal of interest rates. Why have people been selling India down? Let's say if interest rates, which are 8.5, suggest that the market multiple should be 11. But if interest rates reach 5, the market multiple will be 20. Because multiplying these two must give you a total of 100. Right? So, given where we are today, we are in a braking mode where we want to slow the economy because we think there's inflation and we want demand to slow down. But there will come a time when we'll say, now we've braked so hard that the GDP is going to less than 7% and it's hurting. We want to revive GDP back to 9%. How do you revive? You also have to start releasing credit into the economy and revive the animal spirits by giving some profit opportunity. In the previous cycle, in 2002-03, it came by way of privatization. So a Maruti was given to Suzuki, a VSNL was given to Tata, a Hindustan Zinc was given to Sterlite Group. That created a spirit of momentum in the country.
I remember you using the word mania in 2008 for Indian equities. Do you think gold is a mania?
I think gold is resembling close to that now. The rise is very parabolic. I'm extremely worried that investors have started buying this as an equity product. And if you think of gold, and Warren Buffett described it very well, you put all the gold in the world together, it adds up to a building the size of Rockefeller Center. It's worth $7 trillion. and all that is good for is you can sit and look at it and admire the shine. As against that, you could buy half the companies in the US, even today, at that valuation. And which one would you rather have on a 5-year basis? Now, gold to me resembles insurance against currency debasement, which is why people have been buying it, that someday the dollar will become like the Zimbabwean currency, let's say. But the day that occurs, the day after that, who is the buyer for that gold? So, like every bull creates its own bear, every mania has its own end written into it. So, gold at some point will also correct 50-60%. Now, whether the top is $2,500 or $3,000, I don't know. But you will certainly at some point see $1,200 for gold as well.
So for viewers who are watching this show and they want to benefit from this interaction, how should they start investing? Should they invest 20% right after this interview, wait for a decline, then invest another 20%?
Golden rule of asset allocation is, first, what is your allocation to equities? If you're 4% in equities, and let's say you're a 40-year-old, you should have at least 40% in equities. Now, whether you want to put 20% of that 40 today or 50% is really a call on what stomach you have to see some volatility. But the first message is, don't try to be a trader and make money in 6 months. Second message is, why do you need to do it yourself when you have funds available to do it for you at 1-1.5% charge? Please pay them instead of paying the broker. And third, if your asset allocation itself is not right, please start tilting it in favor of cash flows. And I want to again remind people, in 1991, the largest profit-making company in India was Tata Steel, 150 or 151 crores. It got breached by Reliance in that year. Reliance Industries was making 151 crores or 152 crores in 91. 2011, I think the number is in 10,000 crores or some such number. That's the level and magic of compounding. That's the level and magic which a business can give you. I cannot make the case that gold or real estate can go from 150 to 10,000. I can make the case for any company you choose to buy, whether it's Bajaj Auto, whether it is HDFC, whether, whatever you like. These businesses are going to be around 10 years from now and you will make money in them. So why are we not willing to back our businesses, and why are we so obsessed and worrying about, Greece and France? They made a mistake, they will pay for it. Why are we so worried about it?
So I'm just going to wrap up this interview with a very basic question, a question which I often get in my email from our viewers, which is, on a 3-year basis, if I take the clock back, fixed deposits have managed to beat equities. Next 3 years, do you think equities will beat fixed deposits?
Very, very likely.
By a big yardstick, or you think neck to neck?
Big yardstick.
Mr. Chokhani, really appreciate your time. Always a pleasure to have you on the show.
Thank you.
That's it on this Diwali special. I'm Nikunj Dalmia signing off. Thank you for watching the show.